Greetings. We're excited to welcome you to our State of the Markets update, where we'll be talking about what happened in the stock and bond markets and some of the other markets around the world in the first quarter. We'll also be looking at some economic indicators. And then towards the end of our time, talking about how the next generation views stewardship and ways that we may be able to encourage them. As we do this, of course, we always say that past performance doesn't indicate future results, and indices are unmanaged and can't be invested into directly. So with that, let's dive right in to what happened in the first quarter. In the first quarter, we saw the stock market both in the United States and internationally move up, and more or less the bond market went sideways. So the U.S. stock market, buoyed by the hopes of interest rates being cut, grew at a rate of 10% over that first quarter, led largely by large companies and growth companies that we'll talk about here in a moment. International stocks went up about half as much, up 5.2%. The emerging markets were the laggards. They went up 2.2%. If you look at the U.S. bond market, down about 0.8%, and the global bond market up about 0.6%. What happened there was interest rates slid up just a little bit, pushing bond prices down just a touch. So in international markets, the interest rate was enough to make up for that, whereas in the U.S. markets, not quite enough to make up for the drop in bond prices. If we look at the specifics of U.S. stock market returns, smaller companies didn't do quite as well as their large counterparts. They were only up about half as much. They were up 5.2% versus the larger companies up 10.3%. You can see as well, large value companies were only up about 9%, whereas large growth companies up about 11.4%. So growth companies outperformed their value counterparts. If we look at international developed markets, so this would primarily be Europe and Japan, Australia and Canada, you can see as well, large companies outperform their small counterparts, up 5.6 versus 2.6% respectively. And those value companies, again, underperformed their growth counterparts, 4% versus 6.3% respectively. If we switch over to fixed income, as we mentioned, the interest rate environment increased actually a little bit, putting some pressure on bond prices. And as we've explained in the past, the impact is going to be greater typically on those longer dated bonds simply because they're farther out in their maturity. And so it's like a seesaw. If we see interest rates moving up, it's going to push bond prices down. And the farther you are out on the maturity spectrum, it's kind of like being farther out on a seesaw. And so those 30-year treasuries were down a little over 4%, whereas the aggregate bond market was only down about 0.8%. You can see that 2-year treasuries that would be closer in to the middle there in the seesaw were actually up 0.2%. And those treasury inflation protected securities on the far left there that have some inflation component to them and adjustment were only down 0.1%. As we switch over to looking at alternative investments, if you think about the reinsurance bonds, they were up about 4.6% in the first quarter of 2024. So they had strong performance. That's a nice annualized yield if they should continue to perform at the same level. If we look at direct lending, we only have numbers for 2023. The numbers for 2024, the first quarter, will be released here soon. But as we look at 2023, for the entire year, that Cliffwater Direct Lending Index was up 12.1%. So nice, strong performance on the back of a high interest rate for those private loans. One of the questions that clients often ask is, well, how do we make sense of what's happened in the stock market? Where is it relative to history? Where is the price relative to the earnings? Are stocks expensive or cheap right now? And this is what this slide helps us with. If we look at the left-hand side of this slide, that's the values coming into this year. So you can see in almost every one of these Morningstar style boxes, stocks were a little bit expensive. And particularly for growth companies and the large growth companies, this would be the Teslas of the world, the NVIDIAs of the world, the Microsofts of the world, pretty expensive stocks, about 40% more expensive relative to their earnings when we look at the last 20 years of history, their average price to earnings ratio. On the opposite side of the spectrum, small value companies, a little bit cheap compared to their 20-year average, their price to their earnings over time. But overall, the stock market, if we think about it all together, somewhat expensive. Now, we've seen a rate of return that's nice so far this first quarter. And if we look at the right side, that's where we ended up. So you could see stocks started maybe expensive and they ended up even more expensive. Whether it's large growth companies, small value companies, or just about anything there in between. Stocks ended up even a bit more expensive because we saw a nice rate of return. So this isn't flashing red in terms of an alarm bell of saying, oh, we've got to get out of the market right now. But it does tell us that the stock market is a little bit expensive compared to history, and that perhaps we should adjust our projections for rate of return expectations over the next 10 to 15 years, that we might not get that historic rate of return, that it's high single digits. It might be a little bit lower here if we're doing a good job of projecting based on where we sit right now. One of the other ways that we try to assess how attractive an asset class is relative to its history is through this Z-score. And a Z-score is basically going to show if it's below the horizontal axis there, that 0.0. If it's below that, then an asset class is attractive relative to history. It's cheaper than its historical norm. If it's above that, then it's going to be more expensive than its historical norm. Now you can see in the gray bars there, that's the score as of 1 year ago. The blue bars there are the current scores. So if we look at that, and look at it with respect to bonds, whether it be U.S. core bonds or municipal bonds, both of those asset classes were attractive a year ago, and they remain attractive as interest rates haven't moved a whole lot in that last year. If we look at the equity side of the house, in really each one of these arenas, you can see that the blue bar is ahead of the gray bar. So it's higher. So those asset classes, those equity asset classes are less attractive than they were a year ago. They've pushed up. Now, international stocks are not as expensive as U.S. stocks, and large U.S. companies are not as expensive as smaller U.S. counterparts.
Well, Spencer, thanks for walking us through the first quarter, as well as kind of how we see markets moving both over the last quarter as well as the last year. It's really helpful to look back and see those things. Now, as we look forward, typically this is where we invite some sort of economic indicator into the presentation. Today, it's going to be a little bit different. We're going to still look at an economic indicator, but it's going to be from a slightly different lens. And we want to think about, where are you getting your financial advice? And we want to think about that, like Spencer said earlier, in terms of stewardship as well. We want to think about, where are we getting it? And then as well, if we're getting wise financial counsel, are we passing that along to the next generation? So let's take a look at a couple slides here. And this is from a survey that Nationwide did. And they studied advisors, they sent surveys to consumers. And this is the percent of respondents who access financial advice from social media. So think TikTok, YouTube, Instagram, Facebook. These are people that are going to those sources to find information for their financial advice. So this could be anything from budgeting to investment related advice. And so if we look across the board, Gen Z, they go to social media for advice about 42% of the time. So 4 in 10 Gen Zers responded that they get advice from social media. Millennials, again, about 4 out of every 10. Gen X, only about 15 out of 100. And then baby boomers, only about 5 out of 100. So you can see there's a decreasing amount of people, of respondents to the survey, who get their financial advice from social media. If we move forward and think then, okay, what is that percent of non-retired respondents who acted on misleading financial information that they saw online? This is still from that same Nationwide survey. 42% of Gen Z, 36% of millennials, 18% of Gen X, and 6% of baby boomers. So what this means is they received some misleading financial information online via social media, via an advertisement, and they said, that's a good investment opportunity. I'm going to jump in there. And so they acted on that misleading information. And so when we put these two things together, if you are receiving a lot of information based on social media posts that you see or finfluencers on the internet, we really have to start thinking, are they acting in my best interest? When you receive that information, is it wise? Is it prudent? Is it good? Do you do due diligent research when you see that information? Well, turns out not everybody does. And so we really have to be aware as people that give financial advice, that receive financial advice, we need to be putting that in the context of who is this coming from? Is this coming from someone who is held to any sort of a standard? Or are they just receiving whatever they think is going to make them some money or clicks or greater influence? Is that the type of information that you are receiving and the type of personality that you're receiving information from? And if we move forward, we want to look at this in a different light. So this is a study that was done by FINRA, a financial organization, and this is the percent of respondents by generation with investments in the vehicles listed below. So you can see on the left-hand side, it's cryptocurrency. On the right-hand side is mutual funds. In the middle are investments in individual stocks. And so the dark blue bar are Gen Z, the light blue bar are millennials, and the orange bar is Gen X. FINRA didn't do this survey with baby boomers, so we don't have that data. But if you look on the far left-hand side, Gen Z and millennials, more than half of them have investments currently in cryptocurrency. If we look at individual stocks, those two drop. So there are more people with investments in cryptocurrency in Gen Z and millennial generation than they have in individual stocks or mutual funds. This doesn't report how much they have in each of those investment vehicles, so it may just be a little bit in cryptocurrency where they may hold more investments in individual stocks or mutual funds. We don't know those holdings, but they have a substantial amount of them hold funds in crypto. Gen X doesn't have as much, about 40%. When we look at individual stocks, they all hover right around that 40% range. But you can see on the far right-hand side, as people age, as they get into those later generations, you're holding more in the mutual fund space. So a little bit more broad diversification, hopefully, rather than just picking individual stocks or cryptocurrency. So we've done presentations on cryptocurrency before. We don't advise clients put any assets in cryptocurrency for a multitude of reasons, but one of them is this website, Web3 is Going Great, is a fantastic resource if you want to know all about the scams and frauds in the cryptocurrency industry. And they report that over $72.5 billion has been lost to cryptocurrency-related hacks, scams, fraud, and other disasters since January 2021. So when you think about this, what I want you to consider is that when you invest in a mutual fund, when you invest in a stock or a bond, you know that there is a likelihood that that company could default, it could go to zero. If you have your money invested at a bank, just in a CD or in a money market account, your CDs and your money market accounts have FDIC insurance on them. Cryptocurrencies have no insurance. When you invest in a mutual fund or stock and bond, there's no promise or guarantee that that stock or bond will go up or it will go down. And there's not those same FDIC insurance if the company does go under. But if your bank has been hacked or it goes under, your money is protected. When your money is in crypto, it is not protected whatsoever. So as we go back and we think these Gen X, millennials, Gen Z who have funds in crypto, if they are receiving misleading financial information online and acting on it, then there is a high likelihood that if they are receiving it based on cryptocurrency, then money is at stake that they may never get back. And so when we think about this at the very tail end, we really want to think, when you receive financial wisdom, what are you doing to steward that? Are you holding it for yourself? Are you taking wise counsel from an advisor, from someone that is held to a fiduciary standard? And are you passing that on, or are you holding it for yourself? And we want to be people that pass on wisdom. We don't want to hold wisdom to ourselves, especially with our kids, with our grandkids, with people that we love and care about and trust. We want to be a people that pass on good information so that they are not taken advantage of. We'll do a video here in a couple of weeks that dives a little bit deeper into other investments that we would say are not great investments. We're going to do a deeper dive into cryptocurrency yet again in a couple months. So we would say, stay tuned, listen to good financial advice. If you see something that guarantees some sort of astronomical rate of return, think maybe this is not actually a person that I should be trusting with my money. There are lots of scams out there. So we really want to say, protect yourself from those scams and frauds. So as we close today, again, we come back and we say, with all of this, past performance doesn't indicate future results. All of the indices that we talked about are unmanaged and can't be invested into directly. And we want to say, even the things that we say, take it to your advisor, consider it within a broad financial plan. Think about what are your goals, what are your desires, before you take any action based on any of the contents in this presentation. So with that, we thank you so much for joining us for this quarter's State of the Markets update.
If you like these financial planning videos, please share it with a friend, and if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.